Welcome, everyone. We are pleased that you have joined us for today's webinar entitled What Every Financial Planner Needs to Know About Form 1099-R. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sujas. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and Linus regularly speaks at industry events. His new book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is now available on Amazon.com. Linus will draw on his legal, tax, life insurance background, and practical experience for today's webinar. And here he is.
To get started, we'd like to do something a little bit new. We'd like to talk about next month's webinar. And what we'd like to do is we'd like to help, like your help in deciding what it is that we're going to talk about next month. The choices are lessons from the Pistons, self-directed IRAs, and life insurance Slayer rules. So what we're going to do is we're going to launch a quick poll and ask you to vote on which one you would like to hear about. So we're going to go ahead and launch that. And if you would make a vote about which you would like to hear about next month, that's the one we'll do. And we'll give you a few minutes for you to cast your votes. Looks like about half of you have voted already, and I thank you for that. The rest of you would take the time to make a choice. That would be awesome. We'll leave the poll open for another 10 seconds or so while you're completing your votes. And we will go ahead and close the voting. And it looks like we'll talk about business continuation planning next month, lessons from the Pistons. So thank you very much. I appreciate your participation there. Let's go and talk about Forms 1099-R. So as I mentioned earlier, this is the time of the year when our clients are getting Forms 1099-R. They are asking us questions about those. In a lot of cases, they are insisting that the carrier fix issues with the 1099-R, and it creates a lot of anxiety on the part of financial professionals who are trying to serve their clients as well as they can. So I think we have to start with what is Form 1099-R. And according to the IRS, and it prints the directions surrounding Form 1099-R, distributions from pensions, annuities, profit sharing plans, retirement plans, IRAs, insurance contracts are reported to recipients usually on Form 1099-R. The taxpayer gets a copy of Form 1099-R, as does the IRS. The form is the payers, the custodian, the life insurance carriers, the mutual fund companies' best guess regarding the correct tax treatment of the distribution. And to me, that's the key element. You know, the Form 1099-R is a guess. It is a guess made by the carrier, by the life insurance company, about what the tax result ought to be, but it is only a guess. It is not the final tax answer. The final tax answer is something that the client and the client's own tax advisor have to take into account. So since it is a guess, there are circumstances under which the carrier will be open to correcting a 1099-R, and there will be situations where the carrier is not open to correcting Form 1099-R. So there are two quick examples on this slide that explain the difference between the two. Say that we've got somebody who has an IRA, and they take a distribution of 10 grand from that IRA, and the carrier, the custodian of the IRA, says they took 12 grand, not 10 grand out of the IRA. And so in this kind of circumstance, the 1099-R needs to be fixed because it reports an incorrect distribution. It doesn't make an incorrect guess about the tax result, it just flat out gets the amount of the distribution wrong. And so that's a situation where the carrier would need to fix Form 1099-R. But in other cases, the carrier's guess is a reasonable guess, even though it doesn't match up with what actually happened for the taxpayer. And in those kinds of cases, it is the taxpayer who will reconcile the information on Form 1099-R to what actually happened on the tax return. So it'll be up to the taxpayer to fix the difference between what was reported on Form 1099-R and what actually happened on the income tax return. And we're gonna talk mostly about those kinds of circumstances today when we talk about specific 1099-R examples. So this is what Form 1099-R looks like. You can see that field number 1 is the gross distribution from a particular account. And in a lot of cases, the gross distribution and the taxable amount in field 2A will not be the same. So let's kind of show you what I mean. So gross distribution in field 1 and taxable amount in field 2 might be different. They might be the same. Field 2 might be blank. And sometimes the carrier will report a gross distribution and might report a taxable amount, but might or might not check the box in field 2B about whether or not it tried to calculate what the taxable amount of the distribution might be. With life insurance policies, there might be ambiguity about, how much of a distribution is taxable. With annuities, might be the same thing. Even with IRAs that have after-tax contributions in them, there might be ambiguities, or Roth IRAs, there might be ambiguities about how much of the distribution is taxable. And so those things need to be paid attention to. You get a panicked call from a client saying, oh, I got Form 1099, I thought this was tax-free. Well, you got to look at the 1099 and figure out what information is really being provided. One other important place on the form, we'll talk about this in a second, is field number 7, where there is a distribution code. We're going to talk about that in a little bit of detail in just a second. And so in any event, there you go. Let's go ahead and move on and talk specifically about some of the examples. I mentioned that forms 1 and 2A are important fields on the form that need to be looked at. There will be information about federal income tax withholding, specific information about specific kinds of transactions, but a reminder that in box 7, the codes are really important. A lot of times when the client takes, for example, an IRA distribution, we're going to be code number 1 on the distribution, meaning that it's an early distribution before age 59 and a half, and the carrier doesn't know of any exception to the extra 10% penalty tax. There are other codes, code 2, 3, and 4, from the distribution where there is an exception to the early distribution penalty. And so there are other kinds of codes. Code number 6 is a Section 1035 exchange, We see that a lot with life insurance and annuity distributions. Code 7, a normal distribution, whatever that means. Lots of other letters when they ran out of numbers that they wanted to use, lots of letters for certain kinds of distributions. And you can see that there are a lot of choices that a carrier or custodian of the account might make in making a guess over what kind of distribution the client actually took from the relevant account. And to make matters even more complicated, in some cases there will be 2 codes in box 7. It might be one thing and another. And so you got to kind of sort out what the carrier is actually trying to tell the IRS in the event that that happens. So let's talk about a couple examples where the client might get a 1099-R where the client doesn't expect to get it. The most common one, perhaps from our perspective, the one that we get called about a lot, is the 60-day rollover situation. And in a 60-day rollover situation, we all understand if a client gets an IRA distribution and within 60 days makes a deposit of the IRA distribution into another IRA, and if the client has not made another 60-day IRA to IRA rollover in the past year, the rollover is income tax free. And it is a valid rollover. The amount that's distributed from the client's old IRA is not considered to be a taxable distribution. And so if the client goes through that procedure and then the client gets Form 1099 from the old carrier, the old IRA carrier, the client panics and calls you up and says, I thought this was supposed to be a non-taxable distribution. And what I've got is I've got a 1099 from the old carrier saying I took a distribution and it's a normal distribution and it's subject to income taxes. Well, remember what I said, that Form 1099-R is the old carrier's best guess as to what the tax result ought to be. Now, does the old carrier know that the client did a 60-day rollover of the IRA? No, there's no way they could know it. And so their best guess is that the distribution was taxable. And they don't know that the client actually completed the rollover distribution. So the old carrier is going to report the distribution as having been taxable, and that it's either an early distribution or a normal distribution. It is up to the taxpayer to reconcile the difference between what was reported on Form 1099-R with what actually happened. And that the IRS, in their instructions for the tax return, normally Form 1040 for a lot of our clients, that you report the distribution on one line, but you show that there's a $0 taxable distribution. If you did a complete rollover, there's a $0 taxable distribution, and you write the word rollover on the actual tax return to alert the IRS to the fact that you did the 60-day rollover. So there's a complete procedure for how to do it. The Form 1099-R is not in error in that circumstance. The client does the reconciliation, and the IRS has pretty clearly spelled out how that reconciliation occurs on the client's income tax return. So if the client's working with a CPA or other experienced tax preparer, the client talking to that person, they'll probably reach the same conclusion as what I just told you. If, on the other hand, the client is preparing TurboTax or TaxAct or H&R Block or whatever tax software the client uses, the client won't have run into this before. And so the client is more likely to be uncomfortable with this. And so I think being prepared to show the client where the IRS says how to do this, it is of some comfort. And if the client's still uncomfortable, you might suggest to the client that this is the year for the client to hire a professional tax preparer or a CPA to help with the tax return. The same kind of thing can happen with regard to a Section 1035 exchange. Section 1035 exchanges are normally income tax free if they're done right. The old carrier, however, is still going to issue Form 1099-R. In fact, they're required to do it, but they will code the distribution as a 1035 exchange. Also, with regard to qualified charitable distributions from IRAs, you got a client older than 70 and a half, they can send money directly from their IRA account to a qualified charity, and it is not considered to be a taxable distribution. They can do up to 100 grand in a year if they do that right. However, they are going to get a 1099-R from the IRA custodian. It doesn't seem to make sense, but the IRS says that that's what the existing carrier must do. It's up to the taxpayer to report the fact that a qualified charitable distribution, a QCD, was taken on their income tax return. In some cases, clients will get forms 1099 where they don't expect them. And it will, in the form 1099, actually shows a tax responsibility for a client that the client doesn't expect. This comes up most with regard to Section 1035 exchanges and taxable boot. Jennifer and I get asked about this a lot. Situation is where there's an old life insurance policy with an existing loan. The client does a 1035 exchange and the loan disappears. If you've run into this before, you know when a loan disappears as part of a 1035 exchange, the loan is treated as a taxable distribution to the extent there's gain in the contract. That is, the loan forgiveness is taxed on a gain first basis. And the IRS requires the old carrier, even though they processed a 1035 exchange, the old carrier will report the loan disappearance as taxable boot. And so the client's going to get two 1099-Rs from the old carrier, one showing the 1035 exchange, and then the other showing the taxable boot portion of the transaction. That's not a mistake. That is what's supposed to happen. The client is supposed to recognize an income tax result to the extent there's gain on the old contract, to the extent of loan forgiveness. That can also happen in a step transaction. That is, if a client does a 1035 exchange of a policy that had an existing loan where perhaps the loan was paid off just prior to the 1035 exchange, sometimes the carriers mash those steps together and you will get a 1099-R, or your client will get a 1099-R for taxable boot in that kind of situation as well. We will also see 1099-Rs in situations where a client is trying to do 72T distributions from an IRA, trying to avoid the penalty tax. Some carriers will not participate in 72T administration, and so the client's going to get a Form 1099-R from that carrier saying that the early distribution is subject to the penalty tax, even if the client is fully complying with 72T. In those circumstances, it'll be up to the client to reconcile the difference between the 1099-R and the client's income tax return. And it's one of the reasons why, if you're working with a client that intends to do 72T distributions, that you work with a carrier that helps with 72T administration, including giving the right kind of 1099-R reporting on the 72T distributions, indicating to the IRS that the carrier thinks those distributions are exempt from the penalty tax. So how do I wrap this up? We covered a lot of ground here. Companies issue Form 1099 reports to taxpayers that are inconsistent with actual tax results all the time. Sometimes where those 1099s are not a true reflection of the client's tax liability, the client's got to fill out their income tax return correctly to get it right. On rarer occasion, the 1099s are reporting a tax result that the client perhaps wasn't aware of but should have been aware of, and it's our job to explain that to the client. In any event, when the clients get 1099-Rs, you know, as we do, that the clients are going to call us and that we have to help them sort out and explain to them. And I hope today's webinar was a little bit helpful for you in helping to sort out how to explain this Form 1099-R to your client and what the client might ought to do next. So I'd like to thank all of you for joining us today. I hope you found the information about Form 1099-R helpful. And at this point, I'd like to turn the program back over to Jennifer, who will wrap it up. Jennifer.
Thanks, Linus. And thanks for joining us today. And join us next month for Business Continuation Planning, Lessons from the Pistons. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. That's 615-224-1291. We post all of our webinars on our YouTube channel, so please feel free to subscribe to it. Thanks again for listening in, and best wishes for continued success.